Hello, everyone. Today on the final bar, we'll talk market following through to the downside. This after yesterday, when the market felt some recovery in there. My conversation with Fred Meisner was about a little bit of optimism weighing in. Today, we get a little more reversion back to the downside. All of a sudden, the pace of this week is really fluctuating quite a bit. A lot of macro headwinds that are sort of coming frothing up to the top today. But let's focus on the charts, which is weaker stocks, stronger bonds. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. This is Dave Keller here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to make sense of these markets together, review the charts, how they've evolved day to day, session to session, most importantly, connect the short-term fluctuations of the market with the longer-term trends. Just a heads up, we're recording this a little bit earlier today, around 3:30 Eastern, so we're not going to have the closing prices locked in. The last 30 minutes are going to be playing out in front of our eyes real time as we record the show. But, at this point, we're certainly seeing a rotation to the downside, and that's been the pace of the day. It's sort of continued further on. Obviously, there's news about, stimulus and the absence thereof and some challenges along those lines. It's certainly causing the market to go further down, with the S&P at this point almost to the close, down almost 2%, with the downside continuing. So far, we're seeing materials, real estate, consumer staples holding up the best. On the downside, energy, technology really driving things down. So energy's been sort of a miss for a while. That shouldn't be a huge surprise, I think, if you've been reflecting on it. But technology obviously reverting back lower after some strength yesterday. Now, we have a lot of great guests. I mentioned Fred Meisner was on the show yesterday. It was a lot of fun to talk about Fred. He has just a great, calm perspective on making sense of things. Next week, we'll have David Settle joining us from Market Scholars. On the 16th, on Wednesday, we have Pat Ceresna from the Market Huddle podcast and Big Picture Trading. And then on September 17th, on Thursday, we have David Auerbach joining us back on the show. He's the author of the Daily REIT Beat, focusing on real estate investment trusts, on real estate, on more income-oriented investments. We are polishing up the final prep for our special on September 22nd called introducing StockCharts ACP. This is going to be a lot of fun. We've recorded some fantastic conversations with guys like Larry Williams, Mish Schneider, Ralph Acampora, Martin Pring, John Murphy, Arthur Hill. The list goes on and on. Dave Landry. We had a lot of fun sort of gathering some great intelligence, some great discussions with these people. And then Chip Anderson, Grayson Rose, and I will be in the studio presenting the ACP platform, the new advanced charting platform that is an add-on, a built-in component to the StockCharts.com experience. And if you're not familiar with ACP, it's going to be a great opportunity to get familiar with it, as well as all the people that have been a part of this journey, getting it to where it's at now. Let's continue on with the show here with our market recap. As I mentioned, we're recording this a little earlier before the close, but the message, I think, has been established well before this moment, which is certainly distribution. Just look at the last 2 days of the S&P. You can see the rally yesterday, the distribution that we're seeing today, and it's driven on the downside by energy and technology. Looking at the daily chart of the S&P 500 here, what we talked about over the course of this week so far has been, I think when the market pulls back after it's been in an extended rally, and I think by any definition you can say that the market has been extended on the upside, almost reaching 3,600, RSI in the extremely overbought range above 80. We had to come back from that, and we're seeing it now. And the first line in the sand for me is 3350. That's the sort of congestion zone that you saw here from the second and third weeks in August. We're there. We closed below it. Yesterday was sort of the bounce up, and now we're seeing a retracement back down toward the lows of that range. The 50-day moving average is pretty close to where we're at, around 3317 right about now. I would not be surprised to see us break that. And I think the real measure is going to be 3,200 to 3,250. That's sort of this range here. And this was, if you think about the top in June, this was sort of the second major top. If you think about if you skip the sort of late March one, I think this is where we're still figuring things out. We finally hit the first top of the end of April. We had the second big move higher in June. And then we had this really 6-week, 7-week period where we sort of felt like we were, consolidating here, building up momentum before we broke higher. And after the break, we retested the low around 3,200, and it sort of lined up really well with the peak from early June. I wouldn't be surprised if that's sort of that next level of that's the point of reckoning. That's where we decide whether or not this has done enough of a pullback to go on to further upside, or if we're going to continue potentially further down. So, the base case, I think we hit 3,200, to be honest. The base case I'm sort of feeling, and again, this is a feeling, to be honest, that the trend is what I'm going to follow. And so I've got, plenty of ways to analyze trend and look at that. And I think that's primary. Breadth, sentiment, all secondary to that. And making a guess as to what's happening next. It's all about an educated guess based on market history and market probabilities. Another 10% move down puts us around 30.50. That would put us down in the range of the pullback after the June peak. And I wouldn't be surprised if we end up right about there, especially on the weekly chart. That sort of makes sense. That's retracing 38.2% of the March to August rally. That would be definitely enough of a digestion move and enough of a corrective move that if we were going to go on to new highs toward the end of the year, that would sort of put enough dry powder in the keg, if you will, to allow us to return to the previous highs. But again, the trend is what it is. First things first, do we follow through below 33.50? And that's what I'm looking for right about now. As I mentioned there, just in the introduction, plenty of moves in other asset classes. I think it's worth noting that bonds actually holding up pretty well today. The long-term picture on bonds has been, stagnant is a way, an adjective I would use to describe it. If you look at the TLT, really since the rally off the March low, we're still at that same level. So while stocks were sort of way up here, they've sort of retraced 100% plus of the February to March sell-off. Bonds are actually, after that first rally out of leading there into April, it's been sort of sideways, and we're still in the middle of that range that we set even back then. We're settling back down to the 38.2% support level. If you take the November of last year low, the March peak, that was sort of that first objective on the downside. We completely blew through it back here in March. But after then, it looks like we've settled in pretty well. That's around 161 or so. Which is the first Fibonacci retracement based on that frame of reference, and we're sort of sitting again on that level. It'll be interesting to see if that's able to hold. So a nice move up in bonds, it appears, could be a bullish engulfing pattern, which would suggest a little more short-term strength going through Friday into the beginning of next week. But overall, the trend still has been meager for bonds relative to other asset classes. Let's check in on commodities, particular with precious metals. We've talked about the long-term trajectory of gold. Overall, fairly favorable and being in this long-term uptrend. What's happened in the short term, though, is it's sort of a bounce. If you think dropping a ball here in the first week in August, and then it keeps sort of bouncing off of the floor. That's sort of the pattern that it's like a physics lesson, seeing the pattern that's evolving on the chart of gold. As you could probably guess, that pattern, a descending triangle, which is a flat support level and a descending resistance level, usually results to the downside. So at this point, a break below 180, which would take us down through the 50-day moving average, that would potentially open the way to further lows in gold and suggest that the pullback that we've seen and the pause in the uptrend may last a little longer in terms of price or time or both. So I think that's a really key chart to be paying attention to right about now. So it's interesting that, with bonds, with stocks, with gold, there's sort of a really key decision point. I think seeing which way some of these charts break, particularly with these ones like gold and stocks, and whether they're able to remain above support levels, if support is able to hold. I think the things where support holds versus where they don't could be very, very telling. Let's continue on this review of the markets so far today. When we look at some of the better ranked stocks in our Scooter rankings, FedEx comes to the top. We've talked about the strength of industrials, and Fred yesterday talked about industrials and materials as being opportunities for further potential appreciation. FedEx comes to mind as one of those charts that's been relatively resilient. It's been sort of long and strong up and to the right, and FedEx is one of those kind of staple names. I don't mean staples, consumer staples. I mean just a staple kind of bellwether name, right? In general, things seem to be pretty good when a stock like FedEx is doing well. And you think about traditional Dow theory, which was Dow Industrials being the producers of goods and Dow Transports, the railroads at the time, being the distributors of goods. The distributors of the goods are now FedEx and Amazon and Target and all these other ones that, either the big distributors, shipping companies, or companies that have a huge distribution network built into their business model. So watching names like that, and if FedEx is able to hold up, I think that would speak to, consumer demand, that would speak to potential resiliency for the overall market. I'm fascinated to see Royal Caribbean, RCL, as one of the top 10 ranked scooter names. Not something I would have expected to see, given the potential headwinds to cruise lines, but it's been a pretty good uptrend while a lot of stocks have been struggling recently. What's interesting about RCL, and why I think it's really telling, this is like a lot of names we've talked about, especially in the financial sector, where they had a June high that they've not eclipsed yet. They're now facing a 200-day moving average from below, retesting that same level. So RCL above 75 all of a sudden starts to look pretty constructive, as in there's potential for further upside. RCL, struggling and doing a shooting star pattern right above a 200-day moving average does not make me feel as optimistic about potential for further upside from here. It feels more like a stock facing previous resistance and maybe a double top of sorts, testing that previous resistance level as well. Overall, so a lot of movements, and I'd encourage you to spend some time after the close going through some of the themes in here. Interesting to see automobiles, airlines in the top 10, and the number one group was in REITs. So it's a bit of an adjustment here as some of the offense has rotated back to the downside. But worth noting, actually, as I'm glancing at this point, 6 of the top 10 industry groups, all within consumer discretionary. We need to take a quick commercial break. Back with our next segment talking about scooter rankings. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Appreciate you joining us every day for our show after the close. As a reminder, we love to hear from you. We'll be doing another mailbag segment on tomorrow's show, and so we'd love to answer one of your questions on the air. You can get questions to us a couple ways. The first is via email, thefinalbar@stockcharts.com. On Twitter @FinalBarSCTV. Just tag us in a comment, or on our YouTube channel, just put a comment below the videos. We love hearing from you, feedback on the channel, feedback on our shows, but mostly what we love to hear are questions that you're running into. I think our goal at StockCharts is to educate, empower, inform, but basically give you what you need to make better decisions with your investments. And if we can help you along the way by answering some of the questions you're facing in terms of charts, technical analysis, indicators, particular themes, particular charts, tickers, things you've heard elsewhere, just let us know, and we'd love to address one of your questions in our next mailbag segment. Let's move on to our next segment called Level Up. This is a routine segment that we do to try to upgrade your use of technical analysis and of the StockCharts platform. Today, we're going to focus on the scooter rankings, SCTR, for StockCharts technical ranking. What I'm going to do is just very quickly orient us to what that means. I refer to it pretty regularly, and if you don't understand what they are, hopefully this will fill in some of the blanks that may have emerged as you've seen me use them on the show. So when we're doing the show, especially when we're doing the market recap, we're looking at particular stocks, I tend to spend a lot of time on my dashboard, right about in the middle of the page for me, which are the 3 panels that I have allocated for scooter reports. And if you don't see those panels, by the way, on your dashboard, just go to the upper right. There's a little gear icon. Click on additional data panels. That'll give you these 3, and you can change what they are by clicking on the little more button. There's a lot of things you can bring in here, but I tend to allocate all of these to the scooter rankings. And on the left, I'm showing the top 10 stocks in our large cap universe. Next to that, I'm showing the 10 stocks that have appreciated the most, the 10 that have depreciated or have gone down the most just in the current trading day. Now, just to explain what this is, trend following is all about understanding the trends, what's working and what isn't. Our founder, Chip Anderson, we were doing some promos just recently for StockCharts, and he phrased it really well. It said that the goal of the individual investor should be, or the online investor, the active investor, should be to figure out where the trends are and to participate in those and anticipate when those trends are changing. And most of the technical toolkit is driven on trying to answer those three questions, to be honest with you. And we designed the scooter rankings as a way of trying to be a bit of a time saver, try to automate that process of understanding what was working and what is not, based on a trend following methodology. So the scooter ranking actually has three components: a long-term, medium-term, and short-term component. It's weighted a little bit more toward the long-term trend, and it uses traditional technical indicators like price, moving averages, RSI, and some other things. If you want to learn more about the methodology, just search for our Chart School article on the SCTR, the scooter rankings, and it'll give you the formulas and explain what we're doing. It's a percentile ranking, so depending on the universe, it's going to rank all the members of that universe from 99th percentile to first percentile. And so we usually refer to the large cap scooter rankings because those are names that we tend to be trafficking in. It's sort of the large cap space. But just so you know, we also have ranking universes for it in the mid cap space, small cap space, a broad ETF ranking industry group. So we actually rank 105 or 106 industry groups in the ranking system. That's the Dow industry groups you see on the right. If you look in the Canadian markets, we take the Toronto Exchange and do that as well. We also do the same for London and for India. So every one of those has its own devoted scooter ranking that we use. There are a couple ways to do it besides your dashboard. The other thing you can do is go to Charts and Tools, and you're going to see a link for the scooter reports. It's a great way to sort of learn more about what it's doing and try to make sense of things. So what happens when you bring this up is you're looking at the scooter reports for large cap stocks. You can switch to a different universe there. So we're going to switch to ETFs. It's going to sort it by default to the scooter ranking. So it's the strongest down to the weakest. You can just click on the column heading to see what's what. If we were looking at stocks, the sector and industry columns would be filled in so you can understand what's what. The ETF list is a really good place to see out of this ETF universe that we have, which is a pretty extensive universe covering asset allocations, sectors, themes, all sorts of things in between, the strongest to weakness. So not surprisingly, at the top, you see things like silver, gold, because overall, based on the methodology, those have been up to the top. Online retail as the first sort of stock-specific one besides the metals. The solar ETF, ticker TAN, is up here. Innovation ETF, you can see others. On the downside, you see things like energy really is what's most prominently located down here at the bottom, REITs and some others. So looking at which which ETFs are ranked strongly or weakly, and most importantly, how they've changed can be really helpful. So if you click on the change column, that will show you just in the last day or whatever time period you pick in the top, which groups or which ETFs have changed the most. So if you're looking at the large cap universe, this is a report that I look at least once a week, if not more, and I pay attention to the strongest stocks, the weakest stocks, the biggest improvers, the biggest weakeners, and I will often do it on a 1 week change, and I do that over the weekend as a way of just making sense of what all has evolved, right? From Friday to Friday, what's changed, what's moved, and I find if you're able to look at these scooter reports regularly, the chances of you being caught on the wrong side of things are a lot less obvious. The last point I'll just make, we don't have time to get into it too much here, but I would just point out that some of my fellow commentators, guys like Tom Boley, Greg Schnell, Grayson Rose come to mind, often will chart the scooter ranking. You can chart it as an indicator on any of your charts as a panel below the chart. It's a great way of just looking at relative performance. Instead of just looking at the relative performance of the stock versus the sector versus the benchmark, put the scooter ranking in there and it'll show you how strong that stock has been versus other names that you might be looking at. That is our level up segment focusing on the scooter rankings. Again, check out our Chart School article if you want more information on that methodology. Our next segment is called Banking on Breadth. One of the key parts of sort of my investment thesis right about now is focusing on the weakening breadth characteristics. And we've talked about it with some guests. We've talked about it randomly. What I wanted to do is just focus a little bit on breadth specifically and look at some of the different ways we can measure breadth and what they're telling us right now about the broad market. As we've talked about many times, my overall macro approach starts with price, and then it goes to breadth, and then it goes to sentiment, and it's in priority order in that way, 1, 2, 3. So number one is price. Regardless of what color you can get, what information you can see elsewhere, price is king. So your number one goal is to track the trends using price. The second way that we can, or the first way maybe we can qualify what we're seeing with price is breadth. And what that does is breadth is essentially participation. If the overall index is doing one thing, what are stocks that make up that index? What are they doing? Because often what happens is at inflection points, you will see a disagreement between the index as the broad measure of the stock performance and the individual names that make that up. And you'll see that in a number of different charts that we're going to be looking at here today that, in my opinion, sort of speak to inherent weakness under the hood with the current market environment. We're going to start with looking at the S&P 500. This is a longer-term chart, looking at the last 20-odd years or so. And we're looking at the percent of stocks above their 200-day moving average, the percent of stocks in the NYSE above their 200-day, percent of stocks in the S&P 500 above their 200-day moving average. So if you think about it, the S&P 500 is here, the 200-day moving average is right around 3,100 on the S&P. So we're about 8 to 10% above that level right now. But 62% of the S&P stocks are in that same configuration, right? So almost 2 out of 3 are in that same situation where they're above their 200-day. But that means 4 out of 10 names are below their 200-day moving average. That's down from almost 90%, which is what we saw in January. So the last time the market was rallying, it felt overextended and people were debating market tops, which I think is back here in January. We had almost 9 out of 10 names above their 200-day moving average. Now in the S&P, it's only 6 out of 10. So less names have had that V bottom and have been able to get back above their 200-day moving average, about 30% of the S&P at this rate. If you look at the New York Stock Exchange, which has a little more of a tilt, a little more exposure to mid caps and small caps because it's an equal weighted measure of all of those names, you can see it's about 50-50. So half of names are already below their 200-day moving average, and a lot of those are outside of the large cap space and down in mid caps and small caps. So it tells you about the characteristics of the market we've seen right now. Second way we'll look at that is the second chart, looking at the percent of stocks in the S&P 500. This is the same line we saw above. This is above their 200-day moving average. Down here in green is the percent of S&P names above their 50-day moving average. If you look at what's happened in the last couple pullbacks, if we look at the pullback here in June, if you look at the pullback we had here in July, the pullback we had in mid-August, and now the pullback we're at now. These last couple pullbacks in late July, early August, and then in mid to late August, the percent of stocks above their 50-day moving average pulled back a little bit to around 65%. Now we've actually dipped to around 55% earlier this week. This is not updated yet for today, so this number is going to fluctuate a little bit in the next couple hours as we digest all the closing prices for all the constituent members of these different indexes. But it's worth noting that we've now dipped below sort of those previous pullback. So all of a sudden, it's not looking like the garden variety, just healthy pullback within an uptrend. It's now in the category of things like the June pullback or the January to February market top, right? It looks a lot like one of those. And the question now is, which one of those? I think we've cleared the idea that this is just another pullback like we've seen in the last 2 months. This is now starting to look like something else. And if you look, the question is, what do we do relative to these indicators from here? What happened in June was we hit 50%, we pulled back up. We never really got below the low from that first pullback period as stocks were able to start recovering, and then the market went higher, and we didn't really look back until the last couple weeks. Happened very differently here, obviously, in January to February, because you had one more move higher. The indicator did not get nearly as high as it was before, and then you really rolled over and got to new lows there in mid to late February. So the question and what you'd be looking for here is whether we're able to remain, in some ways above 50%. That's often a key tell, and I think here looking at the percent of stocks above their 200-day moving average, that would be an absolute thing I would be looking at. But it's also worth noting just that we are now certainly in a different configuration where we're breaking below the previous swing lows on the indicator. That suggests that this is a little weaker than average. What has not been weaker, and I think that's been a little interesting, is we haven't had huge blowout down days in advancers decliners. The cumulative advancers decliners we look at pretty often, and as you probably know, we've seen weaker signals from mid caps and small caps than we have in large caps. It really speaks to some internal weakness, but we haven't had big 90% down days, which often will happen during a negative phase. Here in February to March, you can see we had a bunch of cluster of days where 90% of stocks were down on the day. That's actually certainly very unusual in a bull market phase. and is definitely more characteristic of a bear market phase. However, we really haven't seen that blow-off sell-off yet. It's been pullbacks, and it's been in a smaller number of names. Big technology stocks have pulled back. Tesla's pulled back. The indexes have. But a lot of stocks are actually not pulling back yet. Things like in industrials, things like airlines, things like Nike, a lot of consumer discretionary materials names. There are plenty that haven't really been shaken out that much, haven't had huge down days as much as others. So seeing an increase in that over time, I think would speak more to the potential for further downside. The number of new highs on the S&P has gone away in the last couple of days. We have been averaging pretty good around 30, 40 stocks in the S&P every day, going above, going to a new 52-week high. That spiked on this last big move higher. You had almost 20% of the S&P making a new 52-week high in the same day. As you can see, that's pretty much gone to zero, essentially meaning everything's coming off of those highs. You'd want to see that increase to start to feel a little more optimistic about the ability of the broad indexes to get to further highs. This one is not color-coded yet, but as you can probably see, if you look at the S&P 500, the cumulative advanced decline line has remained healthy, has remained okay. But if you look down here to the percent of stocks above, the mid-cap index or the small-cap index, all starting to actually roll over. So the inability of those breadth lines to hold above support and to break to new swing lows, I think speaks to some of the inherent weakness. And finally, then we need to wrap up the show. I would point out about the bullish percent index. We talked about that earlier this week, where it had what's called a bear alert, which is above 70% of stocks in a point and figure uptrend. That's actually come back below 70, which usually in extended bear moves, that usually is how we would kick off that downward trend. So that is our deeper look at breadth. This chart list that I'm looking at is called Breadth Indicators. This is part of the morning coffee chart pack that I have on the chart pack table. If you go to your dashboard, click on your chart list and go at the very bottom to where it says Manage Chart Packs. You can download this and all the other chart lists that I tend to use on the show. We need to wrap up the show going right to the 3 in 3 charts in 3 minutes. Here we go. There's a breadth theme for sure. That's sort of the theme of the show today. So I just want to reinforce 3 key breadth charts I think you should be watching. Number one, we just talked about this a little bit ago, was the advancers and decliners. In big waterfall declines, you would usually see a cluster of days where 90+% of the exchange listed names are down on a single day. That is characteristic of most pullbacks and most downtrends, deeper pullbacks. And we saw that, for example, here in mid-June, that big gap down day. We haven't seen that yesterday, which speaks this week, which speaks to, I would say, the fact that the indexes are down, but it's more about rotation and less about a huge decline at this point. Having said that, the breadth readings are what suggests to me that we may start to see those. Second is the McClellan oscillator, and essentially it's whether this is above or below zero. It's a different read on advancers, decliners. It smooths it out with some exponential averages to try to get the noise out of it. If this is above zero, it tends to be bullish. Below zero tends to be bearish. What's happened is it turned negative here the 3rd week in August, right at the beginning, and has remained negative, which so basically overall speaks to a weakening when you look at breadth and not a strengthening. If and when that gets back above zero, that might suggest to you that the downtrend, the pullback, the digestion may be over, and you can start to think more about potential upside or recovery. Finally, if there was one breadth chart I would be looking at, it might be this one, which is looking at percent of stocks above their 50-day moving average, above their 200-day moving average. And again, the fact that we're now breaking down in the percent of stocks above their 50-day tell me every time we're pulling back, more stocks are breaking below their 50-day moving average. That's a key level that the S&P is at right now. And part of my overall view on the S&P is, are we able to hold 3350? Are we able to hold the 50-day moving average? If those two answers are no, I think you have to start looking for further downside, further pullback levels, and further risk management ideas as you plan for the potential for further downside increasing. Overall, uptrends are made of over 50% of stocks above their 200-day moving average. So that's a key level if things start to get worse from here. Folks, that's our show for today. Thank you so much for joining us. It's always a pleasure to share with you what we're seeing, looking at the StockCharts.com landscape, looking at the different charts. I'd encourage you to send in your questions for our mailbag segment. Shoot us an email, thefinalbar@StockCharts.com. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.